It's January 28th and it's a Thursday, and this is the video log that takes 30,000 to a million. And today I'm going to talk about the wallstreetbets GameStop saga, okay, and the Robinhood cutting off trades, cutting off people from being able to buy stocks and whatnot. But just a real quick overview, just like always, I'm going to run you through the account. I'm actually down $5,000 since last time we spoke. So I'm going to show you the account now. Sitting at 150,000, over $3,000 loss. It's mainly due to Apple's slip. So Apple used to be, 140 something. Now it's like 130, I don't know. But I'm going to run through the positions real quickly. Let me scroll back up from top to bottom so you can see exactly what positions I have. Here's the ticker, then the strike price, whether it's a put or a call, the expiration date, number of contracts, whether it's a seller or buy. And then I'm just going to scroll quickly through them. You can pause the video at any moment. You can find out exactly what kind of positions I have. A lot of the puts that I'm selling are actually coming close to being executed. So I'm maybe picking up some EPD, some enterprise products, and some more ET, energy transfer. So I guess I'm going to be going long oil again pretty soon. Wheat and precious metals had a nice pop day today, and I think it's mainly due to some rumors that I'm continuing the list here. I'm finally getting to the last of it. You'll notice a couple of new positions here, actually, EBIX and BPYU, and I'll talk about those positions if I remember to at the end of the video. So here's the account tab if you're interested in that. It's loading. Oh, there it goes. Okay, so cash, it says $12,000 less. I had $21,000 not too long ago, just yesterday. So I made $10,000 worth of purchases. Stock options, stocks and options, 138,000. This is the total value of the account, 150,000. These are my positions sorted by total return and then sorted by equity. Okay. Apple is the biggest, number one in both categories. Here's the final look at the account. Week performance, still up on the week somehow, amazingly. Month performance, and Robinhood's being really slow lately. It's experienced some really dramatic volumes today. So anyway, I'm done talking about the account. So what's going on with Robinhood, with wallstreetbets and GameStop, right? So for those of you who don't know the exact mechanics behind it and don't know what's happening, there's a group of Redditors, 2.8 million of them, 345,000 active at any one moment or something like that. These people decide that it's a good idea to bid up the price of a stock, and the way they do it, they found a very easy way to do it without having a lot of money. And so what they're basically doing is forcing short sellers to cover their positions, meaning if you sell a stock short, you are hoping that you can buy it at a lower price for a profit. And so covering the short means that you're closing out the position. Okay, so let's say you have minus 2,000 shares, and closing out the position, you're covering your short, meaning that you buy out those 2,000 shares at whatever price that you can get. So another meaning of covering is if you sell a call naked, meaning that you don't have the underlying shares, but you sell a call, then you what it means is you buy up the 100 shares for that contract. So basically you're covered in the event of any kind of exercise of the option happens. Okay, so that's what it technically means. Now, so what these guys figured out is that if you buy, out of the money call options, they're fairly cheap, but the clearinghouse, okay, the market makers that operate in the clearinghouse, they have to actually take the other side of that trade, right? So you're purchasing that call, and then what the clearinghouse has to do is they have to hedge that, right? They have to cover themselves basically by selling you the call. So they actually have to purchase close to 100 or the exact 100 number of shares of the underlying asset, right? So, for example, if you buy out of the money, call for GameStop, someone out there, a market maker, is going to have to buy 100 shares. All right, you're spending $15, or it used to be $15. Now the premiums are skyrocketing, right? But you're buying, let's say, $15 worth of a call. They have to buy, let's say $150 or $200 worth of shares. So the multiple is quite big. Okay, it could be even larger than that, depending on how far out of the money you buy the call options. So out of the money just means above the price, the current price. So what happens now is that you have all these market makers that are forced to buy these positions. Now, normally that's not a problem, right? Because 90% plus of these options end up expiring worthless. And so the market makers actually make money, okay, out of the whole transaction, because 90% of people lose who buy these options. But what happens is that the system is just kind of not built for people being this naive, right? Or this, I will call it dumb in smiley face quotation mark. I'm not going to use the R word that, wallstreetbets likes to use. But not that I'm against language, but I don't want to start anything here. I do not mind cursing at all. I kind of like it. It feels good. But anyway, so a lot of these market makers are forced to buy a ton of shares, and that bids up the price shares. Now this creates a big problem for hedge funds and other funds that look to profit from the demise of companies. Okay, they're named short sellers, right? Short sellers meaning that you sell stocks you don't have, and hoping to buy them back later for a profit, right? So these type of funds, they're going to be losing a ton of money, okay, because the price is so high. And now that increases their carry cost. So what that means is that when you borrow something or when you rent something out and you got to return it, right, at the end of the month or at the end of the week or whatever, you don't have to return it in this case, but every day that you hold on to that thing, you pay rent, just like renting out a car or renting out an apartment or whatever, right? You pay rent periodically, so they have to pay rent. But the higher the value of the stock, the higher the rent is. So the more money they put into this, if the stock goes from 10,000 to 200,000 worth, then you have to pay interest on 200,000, right? You have to pay rent on a $200,000 car, not rent on a $10,000 car, which is much different, right? It becomes a much bigger a problem. And there's even a bigger problem. So there's problem number 2. This is problem number 1. But a bigger problem is very dependent on the funding of the basically capital providers, the creditors of these funds. So they're kind of the big shot callers. Everything really depends on them, because if they stop providing credit to these funds, they're going to go bust. Okay, so the market's kind of waiting for that moment. And when they stop providing funding, they need that funding because all of these funds operate on margin, right? They're leveraged. And so if they do what's called a margin call on them, just like you get a mortgage call on your brokerage account, they could get a margin call as well. And so if they get that margin call, the creditors don't care. They sell everything, right? We want as much collateral back as we can. You're already negative. We'll take our losses and go home. And so if that happens, these accounts literally go to zero and below zero, and who knows? I don't know what their contract says and whether they're going to owe money past that or just get zeroed out. I really don't know, but I think it's by individual case. If someone knows about that, please let me know in the comments if you know more in depth of exactly what happens to these funds after they go bust from their creditors pulling the rug underneath them. So I would love to hear from you about that. And so, it's very problematic. So that's kind of what's been going on. And my take on the whole situation is actually quite positive. Not because I want to stick it to the man or, stick it to the billionaires. I mean, after all, I'm hoping to be a millionaire one day, and I do want to be able to control assets. And I feel like everybody who's worked hard and educated themselves and put their ass on the line deserves some kind of reward. and so do these Redditors, I guess, for figuring this exploit out. And that word is very operative because that's kind of what it is. It's an exploit of the system because it traps a lot of these two entities, basically the clearinghouse and the fund managers, or the hedge funds, let's say. It traps them in this kind of bind that they can't really get out of unless the stock starts going down somehow. And I think that's what you saw there with Robinhood. Like, a lot of people like to blame Robinhood for what happened, and not being able to buy shares of GameStop or whatever. And I think that it's really kind of almost not their call. I think it's probably 99% the clearinghouse saying, hey, we don't want to have this GameStop, such a huge, multi-billion position of GameStop stock in our books. So we want to just kind of clear it out. And so I think they probably twisted their hand into holding the buying of the stock so they can unload some of it, or the shorts can buy some of it back or whatever. So I don't think it's the funds reaching out to Robinhood, that they're colluding in some way. I think that the collusion that's going on is just basically not collusion, but a flaw in the clearinghouse system and the mechanic. And it will cause some losses, and it will cause them to rethink the way they're doing, and create some backstops in case something like this happens in the future. And I think it's actually really healthy for the financial system. I think it's a really good thing that Reddit users decided to test the limits, and kind of like QA, right? Quality assurance in gaming, like game testers. What they do is they try to be as savage and exploitive as possible into a game to find out all the different weaknesses and exploit them, and then eventually gets patched up with the next software update, and that's kind of how it goes. And that's exactly, I think, what's happening here. And I think that's basically a bug in the system that's live, right? And it has to be fixed real time. And that's why people are improvising, and the clearinghouse is kind of calling shots here and saying, hey, we can't tolerate this. We need to put a stop to it right now until we figure out how to fix the leak. And it is costing people some money, and probably it's their fault for losing that money, of course. Just because you're a big financial institution doesn't mean you should go without risk and unpunished for mistakes that you make, or weaknesses that you have, and vulnerabilities that you're not looking out for actively and can't foresee, and are not smart enough to figure out. I'm not smart enough to figure out. I'm not saying that they're at fault of doing that because they're not smart enough, but I do think that if there's a weakness, it's a good thing that some people lose their money and figure out how to do things better. If the company is now competent enough and it goes under, then a new clearinghouse, a new kind of financial institution will arise that's more robust and learns from their mistakes, which is kind of what happens with businesses in real time. Okay, so I don't think I've ever spoken this fast in my entire life, but I just wanted to get, I don't know why, just want to get my opinion out there on things and describe as well as I can in layman's terms, because those are the only terms I understand. What's going on with the situation with all these companies that are of short interest, and they have a large short interest, and they're skyrocketing for apparently no good reason except a bunch of people bidding the price up. So there's the mechanics of how they're doing it and why they're doing it, and finally, I want to talk about what I discovered as a result of these, discovered, but an idea that I had as a result of these events is to actually look for great companies that do have a large short interest. Normally, short interest would indicate that the company is not doing well because people have done enough research that they know to short it. And people do actually a lot of research before they short a stock, because it's very important. I mean, the risk is unlimited, right? Just like we saw with GameStop. It skyrocketed, and that's a ton of risk. I mean, you could be owing $10,000 today, and you could be owing $1 million tomorrow. Apparently, nobody would have thought that was possible, but apparently it happens in the real world. So it's kind of crazy, and so you better be damn sure that you know what you're getting yourself into. But I got an idea of looking for companies that actually have some prospect for growth and stable numbers and earnings and everything else, and potential to rise in valuation. And so I started looking for companies like that, and I came up across a couple of them with a large short interest. And the reason why I think it's a good thing is because this short, all these shorts, they have to cover eventually. I mean, they could perpetually, theoretically, ride this for years and keep paying interest on their borrowed shares, but nobody wants to do that. Everybody's kind of looking for a short-term event, which means that it provides an artificial floor, if you will, to the price of the stock, because if it goes low enough, there will be shorts covering, and it will bump the price back up. So it's kind of like a little bit of a put, if you will, on the stock. So it's a little margin of safety, in just a different kind of obscure way. And so I started looking for companies that have a relatively high short interest and that are great companies as well. And so I found a couple. One of them is a REIT, and the other one is, deals with travel, like insurance and forex services and all that stuff for travelers, and all kinds of financial services here in the U.S. and India. And I did a little bit of homework on them, and I'll show you right now what they are here. One of them is called, the latter that I mentioned is called EBIX. Okay, so my average cost basis is $57, is down to $52 at the moment. This is kind of the weekly chart. I'll show you here. It's already experienced a bit of a short squeeze, but it's still 30% short interest, so I think it's a bit of a floor. And I really like the company. I mean, this thing started going up even way before people thought about piling on these shorts. So November 6th is when it had its biggest uptick here. But then it continued to climb up, so people saw value in this company. I think I still see a lot of value in it. I think it could go up to 80 or even beyond. If it goes up to 80, I might sell half and then probably do another, year with the rest of the company and see what happens. But it has really relatively nice numbers. I mean, these are just kind of a few simple numbers. Company's 1.5 billion market cap. Is there 15 PE ratio, then a small dividend of 0.6, but it is profitable, right? As you can see, the earnings here, they're pretty accurate, I think, on Robinhood here. The earnings, they had a little bit of a blunder, but it looks like they're fixing it now, and so the earnings are probably going to keep rising. And I think that actually it's a really good bet, and I have put in, let's say, $5,269 into this as a long-term play. And if it does drop, I'm actually buy some more. And I know that's a lot of money, but I'm starting to operate with a larger amount of cash now. So these kinds of plays are not that big of a deal. I mean, if you think about it, $5,000 is less than, it's like 3.5% of the account or something like that. I can't do the math right now. But let's say less than 4% of the account, so that's not that big of a risk to take, even though it just seems like such a large amount of money. I mean, in relative comparison, Apple is like $50,000, right? So that's kind of a big position, but it's really not that big relative because it's only a third of the account. So moving on to the next one, which is just a REIT with decent numbers. And I was trying to figure out why there's so many people shorting this company. And the thing is, this REIT is very much, this is the 5-year chart here. This REIT is very much an awkward one because I was trying to figure out the structure of it, and I think it kind of makes sense to me. But basically, this is not the company. This is basically a subsidiary of the company. So even though it says it's a 17 billion market cap, the company that actually owns this or runs this is like $209 billion dollar market cap, and they run a REIT with some of their income apparently, and it's their project. Okay, so I think it's runs kind of like an option on their earnings, to where past a certain point, all of the earnings they put into this REIT and to pay out 90% of it for tax purposes and stuff like that. But I could be wrong. Like, if you know how exactly these REITs operate, which are subsidiaries of larger real estate companies, I would really like to hear about that, so you can educate me on the matter and see if I have something wrong. So I'd be really interested in hearing that. So if any of y'all are listening and know something about this, let me know. But as far as I can tell, that's the structure they're choosing to undertake. But the company, the rest of the company underneath, owns a ton of super extremely high profile like office spaces in really, really populated and very famous areas like, London or Hong Kong or Singapore or something like that. So Macau, I don't know. Really very like, center of the earth type of stuff. So to me, these are spots that are going to be there for a long time. So I think it's fairly reliable, even if the price of their, people renting out their properties fluctuates. It goes down a bit every once in a while. This fund might drop substantially, but I think the potential for payout is quite huge. So let me know what you think about that. But with all that said, hopefully you all got something out of this video. I mean, I know I did quite a bit of research in the last couple of days to try to figure out like exactly what's happening and how I can benefit from it in a non so risky way, because I'm not the type of person that throws down 150K on GameStop at these types of valuations. As much as I'm entertained and I applaud the efforts of people who want to exploit and test the systems, I am not one of them. Right? I would much rather see I liked what's happening because these types of events will strengthen the financial system, and I think we're all going to be better off for it. I do think that some people deserve to lose money because they have misplaced risk, or they're not either sizing appropriately, or they're too greedy off of the demise of some companies. So perhaps they need to pay for their over leveraging or risk taking. And look, that might come to me as well at some point. Like maybe I'm taking on too much leverage and I'm gonna have to pay the piper at some point, and that's fine and that's fair. And losing money and making money to me isn't news. It's happened in 2008. Some people made a lot of money. Some people lost a lot of money in 2000. Some people made a lot of money and lost a lot of money. So I think that's perfectly normal and fine. And I'm without an opinion either way there. I just think that this stress testing, if you will, or exploration of weaknesses in the financial system will just leave us stronger in the end. Hopefully not too much regulation though. Hopefully the private sector decides to fix this on their own. I think we'll be better off for it. All right, well, with that said, I think this my rant / lecture / opinion / review of my account is probably over. So I'll talk to you probably on Monday. All right, peace out.